At Staples Business Advantage, nothing can top the smarts and instincts of the thousands of experts on our team. While AI excels at
processing data, automating tasks, and providing insights for better decision-making.
And when they're used together, they're far more powerful than either is alone. Whoa.
I've never felt more alive.
Let Staples Business Advantage use today's latest innovations, plus our team's experience to make business easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
Shares for Beginners. Weekend Watch List.
G'day and welcome back to Shares for Beginners Weekend Watch List, where we'll be taking a close look at an individual company, sector or ETF that you may wish to consider for your watch list. It's not a recommendation to buy, but a way for you to learn how experts screen for value. Joining me today is Mark Tobin from Coffee Microcaps. G'day, Mark.
G'day, Phil. Good to be back on.
Good to have you back on. So, Mark, you're going to be looking at Xero Holdings, ASX code SHM. Tell us about Xero and what do they do?
Yeah, Xero is a pretty simple business. They distribute products. They're a distributor, whether that's third-party brands, where they're the distribution agent in Australia or New Zealand on behalf of brands, or more recently they've gone into the private label or their own brands and developed some interesting products and have started distributing them both in Australia and New Zealand, but also into Europe, into the US. So, it's at its base, basic level, quite a simple business. They buy or manufacture one price and then sell to retailers around the world at another price, and they just make that little distribution margin in the middle. Business been around for many number of years, so like a long track record, and it's more recent developments in the own brand space makes it interesting. And I just think they're in quite a interesting position where they are at the minute.
I have to make a disclosure here because I hadn't heard of this company, and then when I did a bit of research before our discussion, I realised that our range hood in our kitchen that we bought is Robin Hood brand, which is one of their brands. And I got to tell you, this is the most bulletproof range hood I've ever seen. Sometimes they're very flimsy, and the fan on it, I can't believe it. Like if you put it onto number 3, it would suck your face through it. So I think they're very well built.
Yeah, and I think that's you've kind of upstaged me of what I was going to say. The name of the company, I guess, wouldn't be familiar to a lot of people. Well, and it's a microcap, so it's probably not familiar to a lot of ASX investors either. It's capped around 110, 115 million. So not tiny, but still, even by microcap standards, it's one of the smaller size. But yeah, I was going to say the probably product that most people are familiar with that they distribute is your Casio calculator, scientific one that you would have had in high school or university. So they've been Casio's distributor exclusively in Australia for the last 30 years. So if you've ever bought a Casio keyboard or a calculator or any kind of Casio branded product, you've basically been a customer theirs. More recently, they've gone into the own brand stuff, as I said. Robin Hood kitchen appliances, Omega kitchen appliances. But probably the one that most people might be familiar with, or have at least seen, given the colourful nature of the product, is the Everture barbecue range that they've, partnered with the famous chef Heston Blumenthal. And that's, really, I guess, their kind of marquee own brand product. And then on the third-party brands, Casio would definitely be their kind of marquee brand. They also do Pioneer, but that's only in the New Zealand market. They don't do the Pioneer stuff in Australia. But, two big brands. I think the 30-year relationship with Casio, I think gives a sense of these guys are well established in the market, know what they're doing, have deep networks and channels into retailers where they can now start selling some of their own proprietary brands that they've kind of developed over the last few years.
I have to say, Mark, it's great to be talking about a stock that's not a tech company. This is a very old school kind of company we're talking about here, isn't it?
Yeah, I was listening to some of your other guests that you've had on this weekend watch list episode. There's a lot of tech and growth, and as you say in your intro, how we screen for value. And I think, Shiro is definitely one that throws up a lot of value. I mean, as I say, it's got a market cap, call it on today's share price, maybe 115 million. At the end of their last result, they had nearly 18 million in cash on the balance sheet with no debt. So, you're nearly talking the bones of 15% to nearly 20% of their market cap in pure cash. They pay a dividend. So they paid 7 cents fully franked for the last 3 years in a row. I'm kind of expecting them to pay maybe a little bit more in this coming year. They've been holding that dividend steady for the last 3 years as they've kind of pushed money into building out the Everdure barbecue range in particular, getting set up in new markets, marketing, product development, shipping, just getting a brand off the ground. As anybody who's maybe ever launched a product-based business will tell you, there's a lot of upfront costs before the sales kind of catch up. And that's what they've been doing in the last 3 years, as well as paying down debt. But go back 3 years ago, they were paying 10 cents fully franked. So, I'm hoping this year with the big cash balance, the debt gone, the brands starting to get traction, especially the barbecue brands, that, maybe they can nudge that dividend maybe up to 8 cents a share. If they do that on today's share price, you're looking at a fully franked yield of about 7%. So 7%, at any stock is pretty good. And I think 7% for a microcap is pretty exceptional.
And the balance sheet's pretty strong as well. Tell us about the balance sheet.
Yeah, as I said, they've got their debt down over the last few years. They've got it down to zero. And now they've got this big cash balance that they're sitting there with. And, they just recently had their AGM because they're a December year end, although that's changing now this year. They're moving to a standard June year end. But at the AGM, the comments were, they're looking around for an acquisition that would potentially fit with what they're doing already. The key about distribution businesses is, for the most part, you're leveraging quite a heavy fixed cost base. So the more product you can push through the warehouse, either faster or in terms of the sheer number of products, the better. So it's all about volumes in the distribution game. So they're looking around for an acquisition. I think they might be struggling to find something because they said if they couldn't find anything by the end of 2021, they were going to relook at the balance sheet and, how much kind of capital they need to keep on there. Now, that says to me, if they don't find an acquisition, I think they're definitely going to start looking at potentially a special dividend or some other way to return value to shareholders. But I think a special dividend is probably the most obvious choice to me. So, with that big cash balance, I think the balance sheet is giving them plenty of flexibility to do an acquisition that they won't need to borrow for or they won't need to raise money for, or in the absence of this acquisition coming to fruition, then they're going to relook at maybe a share buyback or a special dividend. But I would think, a special dividend is probably a bit more likely than a share buyback at this point.
And growth by acquisition can be a risky thing. Are there any other risks that you've identified with this company?
Yeah, so the expansion overseas, if you look at their last annual report where it breaks down the sales by kind of geographic region, you can see that their international business is still not profitable. And that's why I was saying, they're keeping the dividend kind of steady over the last 3 years as they build that out. It's getting pretty close to break even or even profitable. I'd be expecting that in the next kind of 12 months. But with global supply chain still in a mess after Corona, it may push it out a bit longer. So that's why the key risk is that international business not turning profitable in the next kind of 12 months, as I would expect. That's kind of one of the risks. They export to 33 different countries. So it's how all of these various countries open up as vaccine rollouts happen. The US and the UK are, definitely leading the way, but, they supply many other countries in Europe. And it's about how fast these economies can reopen, especially when the barbecue range is their kind of marquee product overseas and we're heading into Northern Hemisphere summer. You're heading into peak season for those sales. So that's kind of one of the key risks is how fast these countries open up, and then what that means then in terms of pushing that international side of the business into profitability. Other than that, as I said, I think they've got a rock solid balance sheet. So, I think it would take something really from left field, I think, to kind of knock them off kilter that would see them, raising capital or, cutting the dividend at this point.
So we're looking for a barbecue-led recovery then.
Yeah, a barbecue-led recovery. From the AGM, they did say that margin pressure was a bit of an issue in the US on the barbecue side due to some kind of tariffs that are still in place from the kind of Donald Trump era. But they did call out the UK and to a lesser extent continental Europe as actually going quite well. So, net, I still think they're on track. But yeah, that's definitely the growth engine of this business. The Casio business, I think it gives a nice foundation, and it's a steady business that they know well, that they make money out of. But you wouldn't say it's exactly growing, or it's growing very slowly. I mean, given the biggest selling product that they do is the school calculators, it's a function of how many high school and university students there are. So, which is kind of linked to population growth. So it's never going to be really a high growth business. But what it is profitable, steady, and it gives them nice cash flow to kind of channel into these other brands that they've been working on over the last few years and which are now, starting to gain traction. And, it makes quite a difference when you have a division or a product line that, flips from suddenly losing money to making money. It really has a disproportionate impact on the bottom line.
Mark Tobin, thank you very much for joining us today.
Cheers. Thanks, Phil.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. Thanks to Christopher Soulos for music production out of Garlic Breath Studio. Remember, music flows when the money don't.
At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes. Only algorithms.
At Staples Business Advantage, furnishing your office is easy. And with the best warranty in the business, we're committed to you now and down the road.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.